The stock market feels like the fastest way to get rich, right up until the moment someone starts throwing around a dozen words you've never heard. That feeling of confusion isn't just frustrating, it's dangerous. It makes new investors either freeze up and do nothing, or even worse, make huge mistakes without having a clue. They're basically gambling in a game where they don't even speak the language. But what if you could learn the 7 key terms that separate the pros from everyone else? That's what we're doing right now. We're going to break down the 7 foundational ideas that will protect you from yourself and instantly make you a smarter investor. Stick with me, and I promise that in just a few minutes, you'll have the language to turn that confusion into cold, hard confidence. Let's start at square one, the absolute bedrock of investing, a stock. So what is it? A stock, or a share, is just a small piece of ownership in a company. When you buy a share of a company like Apple or Tesla, you're not just buying a digital lottery ticket hoping the number goes up. You are buying a tiny fractional slice of the actual business. You own a sliver of their brand, their ideas, and most importantly, their future profits. Why does this matter so much? Because changing your mindset from "I'm playing the market" to "I am a business owner" is the single most powerful shift any new investor can make. Think about it. You wouldn't buy a local coffee shop without knowing a thing about it, so why would you treat a piece of a global corporation any differently? This is how it protects you. It flips the switch from short-term gambler to long-term investor. When you see yourself as a part owner, you start caring about the company's quality, its leadership, and its potential to grow over the next 5 or 10 years, not the next 5 or 10 minutes. And that long-term view is the most reliable path to building real wealth. Okay, so you know what a stock is. Now let's talk about the first sneaky cost you'll hit when you go to buy one, the bid-ask spread. What is it? For any stock, at any given second, there are 2 prices, not one. You've got the bid price, the highest price any buyer is willing to pay, and you have the ask price, the lowest price any seller is willing to accept. The bid-ask spread is simply the tiny gap between those 2 numbers. Here's an easy way to think about it. It's just like the currency exchange counter at the airport. They buy your dollars at one price and sell you euros at a slightly higher price. That little difference is their profit. The bid-ask spread is the fee market makers charge for that same instant service in the stock market. You buy at the higher ask price and you sell at the lower bid price. How does knowing this protect you? The spread is a direct cost to you on every trade. For huge, popular stocks, the spread is usually just a penny, basically invisible. But for smaller, less common stocks, that spread can be a monster. New investors can lose 5% or even 10% of their money the second they buy, without the stock's price moving at all. Understanding the spread stops you from getting ripped off by these hidden fees and steers you toward more stable investments. You know what a stock is, and you know about the cost of trading. So, what do you buy? For most beginners, the answer isn't one stock, it's 500. This brings us to our third term, the S&P 500. What is it? The S&P 500 is what's called a market index. It's like a giant report card for the U.S. stock market. It tracks the performance of 500 of the biggest, most influential companies in the country, covering about 80% of the entire U.S. stock market's value. When you hear on the news that the market is up, they're almost always talking about the S&P 500. Why is this so important for a beginner? Because picking individual stocks is hard. Instead, you can buy an S&P 500 index fund. It's like buying a pre-made, diversified basket of groceries instead of trying to pick every single fruit and vegetable yourself. You get a piece of everything: tech, healthcare, finance, you name it, all in one easy purchase. But here's how knowing this protects you in 2026. The S&P 500 isn't as perfectly diversified as it looks. A handful of megastocks known as the Magnificent Seven, companies like Apple, Microsoft, and Nvidia, have gotten so massive that they now make up a staggering 30 to 35% of the entire index. This means if you put $100 into an S&P 500 fund, over 30 of it is going straight into just those 7 companies. Knowing this protects you from the illusion of diversification. It's still the best place to start, but you need to know you're making a big bet on big tech right from day one. So you've bought your S&P 500 fund, but now you're getting curious. How do you tell if a popular stock is a bargain or a dangerously overpriced hype bubble? This is where our fourth term, the price-to-earnings or PE ratio, becomes your new best friend. What is it? The PE ratio is simply a company's stock price divided by its annual profit per share. It tells you how much investors are willing to pay for every single dollar of profit a company makes. A high PE means the stock is expensive relative to its earnings. A low PE means it's cheaper. As of early May 2026, the average PE for the S&P 500 is in the high 20s. The best analogy is car shopping. A stock with a sky-high PE of 100 is like a flashy concept supercar with an insane price tag. Is it the future or just hype? A stock with a low PE of 8 is like a reliable, boring, but profitable family sedan. Neither one is automatically better, but the PE ratio forces you to ask the right question. Why is the price what it is? How does this protect you? The PE ratio is your #1 defense against chasing hype. When a stock is all over the news, the first thing you should do is check its PE. If it's way higher than its competitors or the market average, you need to find a very good reason why. Otherwise, you risk being the person who buys at the absolute peak of excitement right before reality comes crashing down. We touched on this with the S&P 500, but it's so important it deserves its own spotlight. Diversification is probably the closest thing you'll ever get to a free lunch in investing. What is it? At its core, it's just not putting all your eggs in one basket. It's the simple act of spreading your money across different stocks, industries, and even countries to lower your overall risk. Why does it matter? Because the hard truth is that individual companies can and do fail. Even great companies can hit a rough patch that lasts a decade. If your life savings are tied up in one stock, you're making a bet that could go to zero. Proper diversification ensures that one bad apple doesn't spoil your whole portfolio. It's like building a championship sports team. You don't want 12-star quarterbacks. You need defenders, you need specialists, and you need a deep bench. When one player has an off night, the team can still win. This is how it protects you. Diversification is your shield against the unknown. It guards you against a new competitor, a disruptive technology, a CEO scandal, or a new regulation that could crush a single company overnight. It might feel exciting to go all in on the next big thing, but smart investors know that managing risk is what keeps you in the game long enough to actually win it. All right, we're over halfway there, and you've already absorbed concepts that put you ahead of 90% of beginners. If you found this breakdown helpful, please hit the like button. It does two things. It tells the YouTube algorithm that this data is worth watching, and more importantly, it helps the system push this video to other investors who are looking for this exact information. Our sixth term is one that most beginners never hear about until it's way too late. The word is liquidity. What is it? Liquidity is just how easily you can buy or sell a stock without tanking its price. A stock with high liquidity, like Microsoft, trades millions of shares every day. A stock with low liquidity, like some tiny, obscure company, might only trade a few thousand. Let's use an analogy. Think about selling your car. Selling a 2023 Toyota Camry is easy. It's a high liquidity asset. There are thousands of buyers, and you can get a fair price for it today. Now, imagine trying to sell a rare, custom-built, three-wheeled car from a defunct company from the 80s. That's a low liquidity asset. It could take you months to find a single buyer, and you'll probably have to slash the price just to get rid of it. How does this protect you? Liquidity stops you from getting trapped in your own investment. High liquidity means the exit door is always open. Low liquidity means you could be stuck holding a stock that's plummeting because there's literally no one willing to buy it from you. This is a classic trap in the world of penny stocks. Sticking to liquid investments, especially as a beginner, ensures you can always get your money out when you need it. Our final terms aren't just concepts, they're practical tools. They give you control and protect you from your worst enemy, your own emotions. They are the limit order and the stop-loss order. What are they? When you go to buy a stock, your app usually defaults to a market order. That just means buy it now at whatever the current price is. That's usually a bad idea. A limit order lets you set your price. You tell the market, I will only buy this stock at X price or lower, or I will only sell at Y price or higher. A stop-loss order is your automated escape hatch. It's an order that automatically sells your stock if it drops to a certain price, putting a cap on your potential losses. Think of it like buying a house. A market order is like screaming, I'll take it, price is no object. You could get a terrible deal. A limit order is like saying, my absolute maximum offer is $500,000, not a penny more. And a stop-loss? That's your fire alarm, getting you out automatically before the whole house burns down.
How do these protect you? In two huge ways. First, limit orders protect you from getting a bad price, especially from that bid-ask spread we talked about. But more importantly, stop-loss orders protect you from yourself. They stop a small loss from becoming a catastrophic one because you were too emotional to sell. Setting a stop-loss is a logical decision you make now to save your panicking future self from making a disastrous one later. So there you have it. A stock is ownership. The bid-ask spread is a hidden fee. The S&P 500 is your diversified starting point. The PE ratio is your hype detector. Diversification is your shield. Liquidity is your exit strategy. And limit and stop-loss orders are your control panel. You now have the toolkit. You speak the language. You've traded confusion for control. But knowing the words is just step one. The real magic happens when you use them to analyze a business. If we can get 500 likes on this video, I'll drop my complete step-by-step guide on how to pick winning individual stocks. Hit that like button to make it happen. And hey, if you found this valuable, hit that subscribe button. It tells YouTube that this kind of content actually helps people, and it makes sure you don't miss what's coming next. Thanks for watching.